What up, outliers? We have our mascot in the house. He was actually just like fully dead asleep. So he's waking up. But he's happy to be here and he is ready to start talking about some options. He likes the condensation from like the cans, but he's very sleepy right now. Getting a lot of face licking. Good boy. I thought I'd let you guys see the man of the hour. All right, let's get my face out of the way. Nobody needs that in their life. All right, let's talk about the game plan for today. I had a few things that I want to cover with you, but my hope is for me to cover them in a bit of an interactive style session. So my objective here is I want to work through with you this process of analyzing trade opportunities and then building a trade off of that. Now, for a quick reminder, I wanted to start with the idea of kind of how to build a trade. We talked about this actually at length not too long ago. And I'll leave it up here just for a moment. And before we get too far down the line here, you know that we got to say hello to everybody. So I see we got Anthony, Elong Songs, Graviterist, Hater, Teddy, Reese, Anthony, Mick, Eric. It looks like Teddy. Teddy says, I really like your vids, but you should drop the GME crap. That's bad for people's brains. Honestly, I don't blame. Like, it's okay if you don't like it. Don't tune into those videos then. That's all I got to say to that. If you talk about GME, I'm outie. Yeah, that's totally cool. You should bounce at any point. That's no skin off my back. And I think that that's a completely fair structure. So Teddy goes, this guy's my hero. I love this dude, but no more GME. Unfortunately, homie, there's going to be more GME. Now, that's not really the focus of today's session, right? So the focus of today's session is outlier options trading for beginners. So I absolutely segment what I do, but yeah, that's totally okay if that's not your bag. For me, I've talked about GME enough to, I think, for most people to understand my interest in it and why I like exploring it. But yeah, that's totally cool if that's not your bag. There's absolutely no problem. All right, let's see who else we got in here. I got distracted. We got Hater, Reese, Anthony, Mick. Oh, I think I already said all you guys. Hounds Trail, Anthony. Anthony says, can we look at Carvana a little tonight? A little more importantly, how do the new brakes on the Vet feel? We got Akshat. That's a fucking fascinating name, got to be honest with you. Wow. Akshat Rastogi. Big fan of that name. Shout out to you. The Roaring Titty's not here. Otherwise, I would honestly have to say I still prefer that over Akshat, but Akshat is not that far off. All right. Anthony's saying, how do the brakes on the Vet feel? The Vet is still being worked on, actually. I can show you the latest picture from right now. I'm installing a much larger catch can because it really needs it. I don't know how well this is going to come through. Let me change this really fast so that you could see. It might be difficult to see, but that's inside the passenger wheel well. And you can see the red is the caliper right there. And then this is the new catch can. So I'm actually running like a dual catch can system, but I have two 12 lines to vent the crankcase. So we are keeping the Vet happy, healthy, ready to rock and roll. We also got Shrey J. Great to see you. All right, so let's talk about this in a theoretical sense to start. I just want to talk about this idea of building a trade, what that approach looks like, and then we'll look through some. Roaring Titty! What's up, Roaring Titty? Man, I'm stoked to see you. I always love seeing that name. It's the best name, I think, ever on planet Earth. Also, the latency should be way better now because I have it updated so that it's a more real time, which is my preference anyways, to be completely honest. All right, building a trade. So one of the issues I see traders very, very regularly make when trying to construct a trade is I think they start from a compromised position, and what I want to do is work through that in detail. So I want to start with getting into the idea and the psychology of building a trade. Then we'll jump in and out of questions. We can bounce around as much as we want. These sessions are designed to be interactive, so feel free. If there's specific stuff we want to look at, throw it in the chat. And then I'm going to base the conversation, though, around the idea of building trades. So my hope is a little bit later in the video, I want you guys to share tickers that you're looking at, and we literally can walk through analyzing them together, because I think there's good experience to be gained there. But we have to start from the beginning, I think. And the beginning, in my opinion, is thinking through how a portfolio operates. There's a video coming out soon, actually, that goes through most of these in detail. I guess I have to add that to my dictionary. Do people not use skill set as one word? I thought that was like pretty standard. Anyways, so I want to talk about the primary generation modality for a trade, at least in my view. It starts with looking at the portfolio. So when I decide it's time for me to put on a trade, there's typically a few things that lead me to that conclusion. I look at the portfolio, and the way it's behaving requires an adjustment in terms of how it aligns with my disposition. The portfolio needs adjustments because some of the trades in the portfolio need to be adjusted, whether it's due to hitting P&L targets, whether it's due to being in the trade long enough, whether it's due to an event is coming up that I don't want to be exposed to, those kinds of things. I can also have just an opportunity that I come across. So the way to think about, for me at least, the origin of searching for a trade, it starts at the portfolio. And the genesis of it is, does the portfolio need something in particular? Or am I just going shopping for opportunity because I need to add some risk? But the reason why I start at the portfolio is because it naturally sends me down different paths that naturally limits my scope of selection. So I'm not trying to solve this giant problem of there's thousands of things I can trade. How do I pick one? So we can work through in detail how that process flows. So let's start with the portfolio. If we have a portfolio, or if I have a portfolio, and let's say that there's no specific portfolio need, meaning I look at the portfolio and it's operating as I want. I don't necessarily need to take risk off or add more. It's right now what I'm highlighting is the ability to be very opportunistic in what I'm searching for. So if we're being opportunistic, we need to make sure that what we're looking for fits in the portfolio. And that's all based on disposition. So let's literally look at the market as it sits now and come up with that. So as we come over here to the chart and we take a quick look at the market, my disposition is right now is we're coming into a bit of a consolidation. And I think that the market is still up heavy on the year. I think that the market ran very, very heavy. And I think the market was due for a pullback of some type. And I think we're starting to see it. Now, the quality of that pullback is different because I see the pullback is drastically impacting tech. We can see this move in tech is very pronounced. We can see the S&P 500 is holding up a little bit better. And we can see that the Russell is actually selling off really, really hard comparatively. So this has been a fascinating move from the Russell, like one of the craziest things I think I've ever seen, where over the course of 2 weeks, it was up almost 20%, and now it's coming back down almost the same, not quite. This is a massive change. Now, a lot of this dovetails off of what we talked about, or what I talked about, I should say, on the recap video earlier today. So my goal is not to go through and rehash all of that. If you have specific questions, happy to answer them, but I don't think we have to kind of rehash all of that. I'm just kind of giving you a general layout of how I'm viewing the market right now. So as I think about looking for opportunities, I then can say, do I have a disposition? Do I want to trade stuff that's going to add bullish deltas to the portfolio, bearish deltas to the portfolio? So you guys tell me, what are we looking for? Pick whatever you want. Are we trying to find trades that are going to add bullish deltas or bearish deltas? And if you don't know what that means, ask. In the meantime, we are indulging again with yet another crystal tonight, but this one, I realize I have to put my hand behind it. The crystal this one is also from Iceland. I have a friend there that sends these to me. And this is nectarine and citrus. Big fan. The orange one I think might be my favorite. All right. So I got to be honest, this looks about unanimous that everybody's looking for bearish deltas, which doesn't surprise me. I think what most of you are experiencing is what's very, very common. And what's common is people don't necessarily do a great job trading things to the downside. And it's actually one of my favorite trades because they tend to be fast, right? You've heard the saying, the market tends to take the stairs up and the elevator down. That's for a reason. And I think you can see that being generally expressed across the market so far, right? So if we take a look at the S&P 500 SPY year to date, we'll see that we've ran all the way up, ran all the way up. And this move from 466 to 565 has taken essentially until the 16th of July. And then from the 16th of July, we've gone from 565 down to 532. So still not necessarily in a correction, but kind of on the precipice. But what I'm highlighting is this is like a bigger percentage move in a shorter time frame than relative on this side. So for me, if I'm looking to trade things to the downside, there's a couple immediate triggers that I would look for. And this is a big one, actually, in terms of, again, depending on what specifically you're trying to build, because even being short the market here writ large, to me, there's a bunch of really, really simple positions that can be built that would run into the downside. But I actually have a different approach. And when I'm looking for weakness, I want to find things that are really, really displaying weakness. So let's look for that. What I'm going to do is pull up a scan, and I'm going to grab a query that is going to look for a few things. This first one is going to look for general negative momentum. Rutabaga says puts seem to always be more expensive than calls. That's very astute observation. Do you guys know what that's called? That is a very specific phenomenon that's well documented. We know it's there. But good eye. I'm glad that you saw that. That's completely correct. Put skew. That's exactly correct. That is called put skew. Now, there are different kinds of skew in the market, but Akshat calls it vol skew. I wouldn't call it that personally, because vol can be skewed not necessarily just to the put side. So I think if you want to call it like put vol skew or something, I'm okay with that. But I think you'd have to be just a little more specific. Now, even something like put skew can be context dependent, because if we take a look at something like SPY and we look at these 49-day options and we look at the puts, same delta puts, let's find these 30s. 30 delta put is 814 to 830. 30 delta call is 632, 649. Sorry, 595, 609 for the 30 delta call. So like literally a 2-point difference. Big difference. Now that's put skew. And there's a very specific reason why put skew exists. Can you guys answer that for me in the chat? And while you're answering that, I will go through and show you another kind of put skew, which is, again, it's all contextual, but I can take a look at the open interest or the volume transacted in a day. And the volume that transacted today also had put skew, just from a volume perspective, where we had 5.7 million puts trade against 4 million calls, more puts traded. That's also put skew from a volume perspective. You can look at it, not from a delta. You could look at it from a delta perspective, but not what I'm talking about. From an OI perspective, right? So right now, there's massive put skew in terms of OI. Elong Song says hedging by institutional traders. That's a good guess. Tommy says market willing to pay higher premium to protect the downside. That's the correct answer. So Elong Songs, you're not far off. I wouldn't restrict it to be that specific though, because it's not necessarily just hedging by institutional traders that leads to put skew, but it is the general willingness for people to overpay to protect the downside. And there's a reason why that has to happen. Because if you're on the other side of that trade and you're selling those puts, you know that you are stepping in front of a train track, and sooner or later it will show up. So in order for this to make sense for a put seller in the aggregate, they're going to demand a premium. So even though technically these are overpriced on a relative basis, they essentially have to be. Otherwise, nobody would transact with them because it doesn't make sense to. I would much rather have a position if these were priced fairly. I would much rather have the downside position. Why wouldn't I? But the reason why I don't trade long puts just for general hedging is because they are so expensive on a relative basis. So good observation. Specifically by, who was that? Rutabaga. Yeah, you'll typically find that. Now, it's not always the case, but generally you will find that as the case. Great eyeball. Back to this scan. Let's find where the trash is. So if we're trying to trade stuff to the downside, there's a couple primary profit mechanisms that I lean on. So for here, you can see that you guys already gave me the purpose. The purpose here is we want something to be able to make money to the downside. Then my job as the trader is to figure out what profit mechanism is going to make the most sense for this kind of thesis. And there's two of them really. There's great volatility trading opportunities that will exist right now. Harder to get short deltas on them, which we'll talk about. Beta weighted deltas to the S&P 500, by the way. That's what I'm referring to there. The easier profit mechanism for downside plays, in my opinion, is to trade directionally. Now, if we want to trade directionally via breakouts, breakdowns, momentum, drift, we have to look a little bit for that, which is the game plan right now. So what I need to do first is actually limit this. So we'll look at like 50 names. The reason why I have to limit this is because a lot of these are custom scripts. And in Thinkorswim, if you have too many of them, it won't populate the data if there's too many returns showing up. So that's why we got to limit it. All right. Also, YouTube wants me to insert an ad, which you guys already know the answer to that. They say it's so nice too. They're like, give it a try. No. We shan't. We shall close you. So what I would do now is take a look on this list. And I want to see what sectors are really showing up here. What is the common theme that I can find across the products? So I can see consumer discretionary is struggling. It's coming up repeatedly. And I can see specifically textiles is not doing well, stuff like that. So this becomes interesting to me. I can also see that IT is struggling a little bit in some sense. And then I can see comm services. Those are like the main things that are jumping out to me, at least from this perspective here. And there's a couple other things we'll want to look at. But what I'm doing is I'm painting a picture for this idea that I've talked to you about before. I don't know if it's in here. It doesn't. Oh, this is more about building a trading approach. That's why. Well, the thing I was looking for in the document to see if I had it is this idea of stacking strength. That's what I'm trying to do. But in this case, I'm stacking strength to the downside. So it's kind of like stacking weakness. So you could call it stacking weakness, but I want it to be strong weakness. So you have to figure out what to call that for yourself. I don't know. So this is looking at stuff with weekly options though. And we don't have to limit ourselves to this, but this is where I'll start. So let's take a look now through consumer discretionary. That's of specific interest to me. Now, another thing that I like to do is take a look at the performance for the sectors, which I'm going to grab now. I have to log into the web platform, so it's sending me an alert. Make sure that it's me logging in. It is me. Please trust this device. Thank you. And then I'm going to go to research, US markets, and I'm going to scroll down here. Okay. So now what I'm doing is I'm looking at the sector performance for the last 35 and 1 day. And I'm looking for what's been hanging out at the bottom most frequently. And guess what it is? Any guesses, you guys? You probably know. If you don't know, you do know. Tech. Tommy is wrong. It is not tech. Captain Chris says, how we doing? Thank you for the live stream. Absolutely. Happy to do it. Well, Tommy already bit the bullet for you guys. There's kind of two things that showed up. There you go, Elong songs. That's what I'm talking about. Consumer discretionary. Literally, that's what's been showing up at the bottom. This is very common. Again, like the way that I scan the markets is not by happenstance. I generally know what I'm going to see after I see these things, right? So if I find products that have been showing weakness and I'm seeing centralization of weakness across an individual sector when I'm trying to find stuff that's near lows, that's not a mistake. So 30 days, consumer discretionary was second from the bottom. 5 days, it was second from the bottom. 1 day, it's at the bottom. Now, to Tommy's point, tech started slowing down. Tech was at the bottom 30 days. Then 5 days, it was third from the bottom. And then 1 day, tech is like fifth from the bottom. So tech is also completely viable here for a downside play. But again, I'm going to particularly look for weakness. Now, I also have to be honest. In general, I don't love fading tech. And it's just because it can be a bit of a bumpy road. It doesn't mean that I won't, but it's not my general preference. So now what I would do is go into something like Market Watch. I would pop open the S&P 500 and I'll take a look in consumer discretionary. Let's just see what's in here. Amazon's getting killed, which is kind of tech. Tesla's getting killed, which is kind of tech. So we can see those are not doing well. We can see Booking Holdings is doing terribly. Airbnb is not doing well. So we can see CarMax is also not doing well. So a lot of these things are not doing well. Now there's an important diversion that happens. I don't necessarily want to pick the stuff that's at the bottom. The reason being is because sometimes things that are at price extremes, the same reason why I would trade any other price extreme, is that the propensity for some sort of reversion is actually kind of high. So I don't want to trade the rubber bands that are expanded all of the way. So that gives me some general ideas to start with. Now what I'll do is come back into the scan and adjust these parameters. And I want to find stuff that's down a little bit more, not just negative, but I want to find stuff that's down at least 5% on the year. So this should clean up some of those results. So we just dropped a little bit more, which is good. Now what I'm going to do is I'm going to find stuff that over kind of the past 6 months is negative. And I want to find stuff over the past 6 months that's negative, that's also negative on the past 1 month. So something like SPCE has been going down very clearly. Something like TDOC is also going down very clearly. SYM is getting beat to the downside. So all of these start to become viable for prospective downside plays. Now today, something like SYM, I noticed that as it came down, you can see that this was a doji. I don't care so much about the doji. I care about the expansion of buy volume. So this shows me that there are buyers that are starting to step in. So it makes me slightly less interested in this to the downside, although it doesn't mean it's not viable. It still is. SPCE looks like a great downside play via something like short calls. So I don't necessarily see this accelerating massively to the downside. And also, do you guys happen to notice what you see here? These are 2 alerts, and it's because I was trading volatility risk premium in this. So I had a position on literally that I took off today. The reason why I was flattening out the portfolio is because I'm going to be kind of stepping away for about a week, just taking some time off. So I set the portfolio kind of for vacation mode. But it's funny that this came up in this context because it's something I've already been trading for this other context, which is variance risk premiums. But that's the way that I would want to trade this one specifically. Now it has earnings. So at this point, I would either trade it for an earnings play or wait until post earnings, or trade it up until earnings. You got another 5 days. But that's the first access to good short deltas that I see. I would come in here and I would just sell calls. Now there's different ways to structure that kind of trade, but that would be an easy one to start with. And it's even on this list just a little bit further down. Let me reorg this. Now let's take a look at TDOC. So TDOC is another one that I like to the downside. This one would be set something like here with a stop at like 827 at or above, really above. 827 is where I'd want to be getting out. But this one is a little more open. I can either sell calls in here because I can still see it has variance risk premiums. So that's mostly going to apply to the puts, but you'll probably see it on the call side as well here. Or we could take a look at structuring some sort of diagonal. Now it has a lot of calls, which is slightly bullish in tenor. But let's take a look at what these puts look like. I don't love them. I don't love the liquidity here. But you notice how these at the money calls, they're at a 23 delta. So the market is really pricing in the downside. The market is heavily, heavily expecting this not to break up towards 10, but definitely even down towards 5. It kind of likes it. I don't want to say it likes it more, but it likes it enough that that's an interesting move, right? So what I'm looking at here, these 2 columns, this is probability of in the money, probability of a touch. The probability of touching 10 in this product right now is 33% against a 44% probability of hitting 5. So this looks absolutely ripe to the downside. Now, again, you could trade it via short calls. This would be fine. Something that's like right at the money. You'd have to put on 1 million of them because it's only $10 and you're going to get like $23, $24, but you could put on a bunch of them. Or you could find some puts to get into, but these aren't liquid enough. So this is just an example on why I would probably also sell calls on this for the downside play. So that's 2 downside trades that we found in just a matter of minutes, really. And depending on how many we would want for the portfolio, this is exactly how the process would go. But I'm going to take a break and take a look at what you guys are seeing. Anthony says consumer discretionary is middle class consumer spending, higher percent of income and rental insurance, less discretionary funds to do things outside the essential. Yeah, I completely agree with that. And I think that in the kind of market that we have now, it doesn't surprise me literally whatsoever to see discretionary struggling here, like literally at all. I think it completely checks out. Ackshot says 5% is applicable to ETFs because 5% drops in stock is common. It's not necessary. I'm not necessarily trying to bifurcate it like that. When I was searching for 5% downside in that context is because I specifically was just looking for things that have clearly shown downside weakness on the year. So I wanted stuff that wasn't just negative over the last 252 trading days, but I wanted stuff that was posting negative returns because there's a propensity for momentum even to the downside. And again, that's why I don't want to look for things that are at extremes because a reversal is very likely. I want to find stuff that's just slowly grinding lower. That becomes a really attractive trade for me. So that's the idea. We have mango orange in the house. I like the mango orange a lot. It's probably my favorite spindrift. Ryan says, do you have any vid? I got a ton of vids. Let me be honest with you. Do you have any vids going over how you use unusual whales specifically for options? Not yet. That's something we could do at some point, but I don't have anything yet. Ryan says, like, when you see bid and mids or structured plays, it can be hard to see. They give real definitions, but it's hard to read the possible play. Yeah, so a couple things when you're using options in general like that is, regardless if it's unusual whales or just TNS, time and sales, the first thing is if you have stuff that's at the midpoint, you can make a guess. So for example, this 110 call 17 Jan got filled at 89 cents. The market was 83 by 90. So do I think that this was likely bought or sold? I would lean towards it being bought because it's 1 penny off the offer and it's several pennies off, 6 of them, from the bid. So I would just innately assume that this was more likely bought than sold. Now, another really important thing for everybody to understand is that none of this is concrete. Literally none of this. So when the market shows this green for buying and this red for selling, they're still guessing. It's not certain. It's very close to certain, but it's not certain. And I think it's important to understand that. So when this is showing the market at a penny by 23, and we see the trade come in at a penny, you can be pretty certain that this happened at the bid. But it's not a direct, like, we don't know that for certain. There's not like a print that tells us that's what happened. We're making an assumption based on where the market is and where the trade was. I just think it's really important for people to understand that, even when you see the coloring here, that the platforms are still making an assumption. So that's that part. Now, the other component that I think for Ryan, it's important to understand is, at least for me, I don't care about spreads. So you'll notice that I essentially get rid of spreads almost always. They don't mean enough to me in this context. Now, you can lose some trades that would come through by spreads that could still be informative if they're large enough. But in general, I simplify it. I'm looking for things that are really displaying some specific strong conviction. So I much prefer single options for that use case. So that's why I will filter out essentially the spreads. So same thing in unusual whales. The mid, you can essentially just drop it off. Again, you can leave it on there if you want and kind of see where people are transacting around to have an idea. So like this mid, let's see, this came in at 90 cents. But see, like, this is just another interesting example. This got flagged at the mid because there was multiple trades that came in with this, but it came in at an average of 90 cents. The market was 90 by 92. So even though this is flagging it as a mid because of the multiple transactions, you could still probably make a guess that these came in at the bid, meaning that they were sales. But again, we don't know for certain. And it's always important to remind yourself of that in the beginning because we don't know yet. So yeah, I'm trying to see other interesting examples. This one's super weird up here. Where was it? No, never mind. So this one, right? So this is like dead set mid. You have no idea and you can't know. So something like this, 495 by 515, if it's like dead set mid, you have no idea. And it's just not even worth your time trying to guess unless there's unless this was like a massive trade. If this was like a $2 million trade, which it wouldn't come in at the mid, that's kind of the cool point. The cool part, that was a mix of point and part. The cool part is that larger trades, they don't come in at the mid. They're too big. They push the market. So you can still, if it's a big enough trade, it's naturally going to trend towards one direction or the other. So it kind of makes it a little simpler actually to find. So this one's 475. And again, this one's dead set mid, nothing to derive from that. So yeah, typically you can just kill the mids off. Because the other thing to keep in mind is from a psychological perspective, if I'm trying to transact at the mid, I'm not in any sort of big rush to put the trade on. It means I'm trying to get a good fill. I'm trying to play the field a little bit. Whereas if you have people that are coming in at the bid or the ask, it means one, again, they're probably moving size. Two, they're trying to get a fill. So you can, again, come up with some reasonable estimations, but reiterate, we don't know for certain. It's an estimation. So hopefully that answers your question. Rutabaga says, I read something about selling poor man covered calls if you can't afford that many shares. Seem too good to be true, but what do I know? I don't know. I would need more context. Happy to take a look at it and explore that with you. And I assume when you say selling poor man covered calls, you mean buying the options and then selling calls against it. That's essentially what I do, which is called a ratio diagonal. I don't like the colloquial names for things. I really prefer the technical terms. It's, I guess, just me being annoying. But that sounds like you're looking at ratio diagonals. So let me throw a link to that for you there. But yeah, the ratio diagonals are a good strategy, poor man cover call, whatever you want to call it. But it's probably not too good to be true. You probably just need to understand the position more, because there's drawbacks. There's a series of drawbacks when you're trading something like a ratio diagonal. So especially the way that I trade them. Again, when I'm saying ratio diagonal, that's the same as what they're referring to, which is the poor man's covered call. Now, the cool part about a ratio call diagonal is I can put it on the call or the put side. The poor man's covered call typically applies to the call side. But long call diagonal debit spread. Yeah, exactly. Yep, I'm following you. So yeah, the strategy itself is pretty good. I mean, when you say seemed too good to be true, what element of it seemed too good to be true to you? And then in the meantime, Gravitera says, when you say sell calls, would those be covered calls? Not necessarily, no. So in the context like here, like we're looking at fading, what was it, TDOC? So if we're talking about fading TDOC, I would just be selling calls. So I would go out, I don't like the 14 DTE, that's a little too close, so I'd probably do 49, which is a little too far, but you know, it's like, what is that fucking, that little lady and the porridge, and she rat fucked all the bears' food because she's selfish. She's a terrible, who the hell was that? What's that story? There's that stupid girl that goes in to the bears' food and she fucks up all their food because she's selfish. She's trying to find the perfect one. Goldilocks. Yeah. Yo, she sucks. Hate her. But with like I literally forgot even how Goldilocks came into this equation. Why was I talking about Goldilocks? I literally just got blinded by rage towards her. Anyways, for short calls, oh yeah, I was looking for a Goldilocks scenario. That's what it was. So yeah, exactly. Gravitera says too far, too close. That's exactly it. Thank you. I was thinking about Goldilocks. That's funny that I had the idea. All right, so let me take a look at selling one of these and then we can plot it. Now, again, this is the risk profile, and this is my pass-through account. The reason why I mentioned that it's the pass-through account is because it has no money in it, but two, because it's regulation T margin, whereas my typical trading account is portfolio margin. I think this is more applicable to people. So the margin to put on these short calls is $123.50. And then if it starts going against us, it expands to like $350, like that Loch Ness monster. So it's a really good return. So in this case, what I would be doing is literally just selling the calls. Zach says, so is this buying a call and a put on the same stock? Never understood what poor man cover call ratio diagonal was. Check out that video up above. The video up above will get you schooled up super fast on what the diagonals are. But it's typically same side. So a Cliff Notes version, which is actually what I'm running right now on CrowdStrike. And I closed it out today, But what I do is I like to go further out in time, typically greater than 60 days. And then if I want to trade it to the downside, I'll look at the puts. I'll find puts that are reasonably bid-ask spread. So like these 77s look okay to me. 48.10 by 49.35. So about 1.2 and a half. That's okay. So I would come in here, look at snagging some of these. So let's say we start with buying 5 of those, and then you can sell puts against it. So then I would go further out of the money, maybe something like these 2 hundies, analyze this, maybe sell like 2 of those to really favor the downside. And that is a ratio put diagonal. I have long puts, short puts, more long puts than short puts, hence the ratio. And the idea here is to try and capitalize on a downside move while still collecting some premium from these short calls against the long options that were purchased. So that's that. All right, let's pivot back over now quickly. Actually, this is perfect because this is talking about structuring trades. So what I would love now is if you guys have trades that you're looking at, anything that you have on, that you want to have on, or just stuff you're interested in, we can take a look at some names and just come up with an analysis. We can forego the portfolio fit component, and then we could just talk about structuring trades. Spicy Avocado says, wouldn't it be better just to pick one and go with it? Not necessarily, no. Now, it depends, again, on what we're looking at, which is if it's something that you really want to trade to the downside, you absolutely can just sell puts. But there's a few things that come into play. It's that, like, if we know where something is going to go, then there's a easy equation. But I don't know where shit's going to go. I'm actually wrong all the damn time on where I think things may or may not go. So the idea is to scrub off some directional risk. It's some delta hedging, but more importantly, it's to help the position, because here's the downside to using options. If I take a look at this 18-oct trade and I go here, I'm losing $8 a day from theta decay. Even though that these are far out in time and pretty far in the money, they still suffer from theta decay. So by selling options against it, I'm also offsetting some of the Greeks' impact. And in this case, theta is a big one. So in the trade that I put on, which was what, short the 200s, I'm essentially collecting $300 per contract. So if we take a look at this, these are giving me 24 cents of theta each day. So even though I have 5 long options that are losing $8 a day, I now have 2 options that are gaining $24 a day each. So I'm able to offset my theta decay for the long options. So it's just another way to look at it. But to your point, there's absolutely nothing wrong at all with just using one. Like if I have a really strong directional conviction, either I'll sell it at a very light ratio or I just won't sell it at all. Another thing I like to do is leg into them. So I'll put on the base position first. That's exactly what I did in CrowdStrike, is I put the base position on as we broke out here. And then I chose to sell puts when it started slowing down. So here, and then I ended up having to roll the puts because we had a pretty big move against. So I wanted to keep them out of the money. But the short puts were literally, it was at essentially for every 10 longs, I had 1 short put against it. So there's a lot of different ways you can set it up. All right, back up to you guys. Arjun says poor man's covered call is usually 1-to-1 and not a ratio. Yeah, exactly. So that's what makes it a quote unquote covered call. Now, that's a downside, right? There's a reason, there's a very specific reason why I like the ratio diagonal much more than a standard diagonal. So let's take a look at a standard diagonal, which is typically buying the at the money. Let's turn these off. And then selling something that's further out of the money. Now we can modify it a little bit too. We can slide that option a little bit further in the money. Let me take this a little further in. Oh, I did the same expiration because I'm an idiot. My bad. I was wondering why that looks so squirrely. So this is what a diagonal often will look like. And sometimes they'll even have risk to the other side. The reason why it doesn't now is just because this has had such a crazy move. The options are priced pretty crazily. So looking at something like this, you can, let me take a look at like a standard diagonal. But anyways, this is what a normal diagonal, you see it's like very peaky, and then it'll have either defined profit or it'll actually have risk eventually in the direction that you want it to go, which is super, super annoying. It's a big problem with them. It's actually why I set these trades up the way that I do. Let's take a look at Apple. Apple's still looking pretty normal. And then let's build a quick trade in here. Same structure. So let's do long these. And let's do like the 50 delta, something that's like just slightly in the money. And then let's sell something near term that's out of the money, kind of like right out of the money, like these 35s. So in this scenario, what I'm doing is I'm being very careful about the delta selection to make sure that I don't have risk in the same direction. Now, what it looks like for a standard diagonal, if you're using the same strike, so let's use, instead of the long slightly in the money, let's do like these 220s, something closer to at the money or even slightly out of the money. Turn this off. You notice you actually have upside, or in this case, downside risk. So even if you get a big price accommodation, it can move, it literally can move too far in your favor. And this is a big problem with diagonals as kind of they're traditionally structured. And this is still giving it a five point spread between them. So I don't like diagonals a ton. That's specifically why I trade ratio diagonals and I set them up the way I do, because one, I don't want to have capped profit potential. And two, I don't want to be penalized if something moves massively in my favor. I don't want to be too right. There's so many ways to be wrong in trading. To be wrong because you're too right is literally just offensive. So that's why I set those up the way that I do. Let me know if that answers. Well, I guess you didn't even ask a question. I kind of just talked about the structure. Rika says, could you analyze Nvidia? Yeah, let's take a look at Nvidia. All right, what do we think? On a 6-month basis, still trending up. 1-month basis, still trending up, pretty strong. 3-month basis, trending up, but flattening down. 1-month basis, and we are negative. We are downward sloping. Standard deviation channels are going down. So when I look at this, this literally right here is actually kind of the initial eyeball spot I see. And the way I look at it is I want to see what it does in that level. If it starts breaking up above this, I'm still not necessarily massively bullish until it starts breaking above these here. And then eventually this here. So if I wanted to trade it to the upside, if I had a long thesis, I would probably trade via short puts, something I can manage or something that I can kind of be slightly wrong and still make money. And then if it breaks down below this, again, I personally wouldn't want to short Nvidia, but if I did, you can either run short calls or like a ratio put diagonal. Both of those are viable. And then the near-term profit target for something like that, or near-term price target, would be something around like 91.5 down towards this point of control, something like this. That is generally what I see. Now, from an options perspective, I still see bullish drift priced in. So 14.9 million calls against 14.3 million puts. So definitely more calls wanting to be traded here. And if I take a look at the implied vol for the out of the monies, and then let's clear off those and take a look at these. So it's all downside risk, really, that's being priced in, not much upside. So yeah, I mean, that's the Cliff Notes version. I'd essentially want to see how this works. All right. Rama Lama says, I think people on here, myself included, don't have the ability to sell naked options. Some of the strategies don't make sense at first because we didn't even have access to the trade mechanism. You still do. Again, like I don't play the victim. It's a bad mindset. If you can't trade naked short calls because of permissions, just buy the wing. Just go super far out of the money. So if I'm trading something like, let's find, well, what the hell were we just looking at that we like to the downside? Something with the T. This is from here. Where are you at? T-Doc. T-Doc. So if you want to trade this to the downside and you can't, literally just go in there, buy that, and then buy a really far out of the money wing. Buy like a 20 delta wing. So you're not going to chew up a bunch of the credit that you're going to receive, and you essentially still get the same exposure, which is looking at a short call vertical. So yeah, we all start with smaller accounts, and you have to be thrifty and, you know, essentially structure stuff a little bit differently, but this is a completely viable way to do it. The downside here is the margin requirement is much greater because it's now just calculating based on the width of the wings. So you might have to slide this in a little bit more and eat a little more of your lunch. So you'd go from 20 cents to 19 cents if you got a fill. So you're losing a penny, but you cut your margin requirement in half. Ideally, again, we would just use single options, but to your point, not everybody has access to them right away. And you just essentially have to get a little more creative. But yeah, you can literally just do something like like by the wings. Ryan says, just want to shout out to you. Happy to be here. I'm happy to have you here. That's awesome. I'm glad that it's useful. Reese says, why do we have upside risk if we have the long call? It's a great question. And it has everything to do with the way that options behave and the way that gamma behaves. So essentially, in the scenario that we're looking at before, which was, I already forgot what that one was in. Was it CrowdStrike? Maybe something like this. No, that's my version. Let's see if we can structure one real fast. Let's do like the at the monies. So I forgot. You literally, I think you can do it with like one click with this thing. Yeah, buy diagonal. There it goes. So what is this doing? It's buying, no, I want to do the other way. Sell diagonal. I literally never use this. It's 20 SEP in the October. I don't like that one. All right, I'm gonna just build it myself. I don't like what they're doing. We have the 20 there. Typically they would be closer in expirations as well, but that's okay. And then the 220 here. So it's more of a calendar spread, but this is like a very, I think that's more what we were kind of talking about, not necessarily the standard diagonal. The reason why is just because it's the same strike, by the way. So like if I do instead of buying the 220s and instead I sell like the 215s and grab the 220s, that's a diagonal. And notice how it has upside risk. So the reason why this has upside risk is because what ends up happening is as the underlying moves, the short deltas move fast enough to overwhelm the long deltas. So it creates a scenario where the underlying itself literally can move too far in your favor once your deltas essentially approximate to whatever their maximum variance is going to be. And a lot of that is based on the gamma. So you'll notice that if you look at the 20 sep, the gamma here is a 1 gamma. Here, if you look at the 16 og, it's a 2 gamma. So that means that if this starts moving too fast or too much in your favor, the gammas are going to pile onto these deltas. And sooner or later, you'll literally have more opposing deltas than you would have started. Reese says, that's been driving me nuts. Thank you. Yeah, you got it. Easy one. No problem. Tell you guys all the time, I got to be honest, like when we're talking about the GameStop stuff, as you could tell, I'm very much a student because I don't know a lot there and I'm learning a lot. But when it comes to options, I'm still a student, but I know a lot. I've been doing options for so fucking long now that most of this stuff is kind of just back of the napkin. So yeah, that's an easy one. No problem. Ukraine says, is it better to buy options to close to the... oh, that fucked me up. That's funny. I was reading as buy to close. So Ukraine says, is it better to buy options close to the money or out of the money? It's a great question. And I've actually made a video recently with GameStop, as I think that's somebody's chagrin. I don't know if I'm allowed to say that because I think somebody said they don't want to hear it, but you know, it's too fucking bad. But I have a video. This will be for you, Ukraine, which is about buying call options smarter. Like I said, I use GameStop as the context for the video because I know a lot of people that trade GameStop are buying options, and the goal of that video is to try to help them out a little bit instead of just lighting their money on fire perpetually. But the video applies to anything. And the answer to that really, it depends on what you're trying to accomplish with the position. So there's different ways you can structure it. So that video will literally walk you through it in depth. It goes through how to pick expiration cycle, how to pick delta, all those kinds of things. So should be good. Oxshot says, in a broken wing butterfly, how does P&L change when the underlying approaches the strikes? Will the profit increase first and then decrease, or loss increases all throughout? If you let me know the exact trade that you want me to look at, we can look at it together. But a lot of that P&L behavior is going to depend heavily on what you pick. So if you outline the trade that you want me to look at, we can take a look at it together. And then in the meantime, we still have a few minutes left. So if there's anything else that you guys just want to generally talk about, let's dive in. In the meantime, I'm going to get my dinner order ready and launched. Tonight is going to be Mexican food. We're going to hit a carne asada burrito and then a pollo asado quesadilla. Although I have to be honest with you, I really like saying quesadilla. I don't know if that's just me, but quesadilla is just a much more fun way to frame it. So yeah, let me know what you guys want to talk about. In the meantime, I'm going to grab this. And I like going through this because I think this is like really, really useful to understand what other people are doing and how other traders operate. There's a big reason for those that don't know. I've always referred to us as the outlier community, even when like the branding overall was ES Invests, which ES is just my initials. The way that this whole platform, YouTube channel, all that stuff started was just like I was sharing information with my friends that were in the military during COVID. Long story short, the community grew, which is awesome. But I've always referred to this as the outlier community because that's what I pursue as an individual, is outlier performance. Okay, so that ties to this because this is a great example of normal people performance. This is a great example of how normal people look at markets and realistically how you probably should not look at markets. So I actually think it's fun to poke through this from time to time to use as examples for us to talk through. Ukraine says, what are your thoughts on SPY? In terms of what? It's an index. It's got options. It's pulling back. Those are the initial thoughts. I mean, it fell right down through this volume gap, right? Like there was no volume here to support it. And I mean, it just dropped right through it. And now it looks like it's entering another volume node. The next volume node is literally right here. You can see it right there. And that's where it's hanging out. So to me, if it starts breaking below that, then it looks like it's going to want to go somewhere down here to like 523, something like that. But I think the market right now is very, very, very driven by news, very driven by news. So if we have some sort of advantageous market data come out, then I think it will be favorable. I think the S&P 500 will shrug it right off. If that doesn't happen, then I think the S&P 500 probably likes the downside here. And then let me grab the New York Stock Exchange really quick. Yeah, so even the New York Stock Exchange is starting to rotate down, right? So gross lows is expanding, gross highs is contracting, and net highs lows is declining. So this is even in the New York Stock Exchange starting to want to rotate down. So yeah, that looks pretty rough. Colonel says, can you look at Intel? It had bad news all over leading to earnings. Let's see. INTC. Yeah. Did terrible. Let me see. I had Intel on my watch list, but I don't think I traded it. I didn't for earnings. Why did I not? Let me look really quick. I had it on my no-go list. Oh, that's why. Just because it had way too many previous beats, right? So 1, 2, 3, 4, 5, 6. Literally 6 out of the past 8 had been negative beats, meaning realized vol exceeded implied. So that's just no good from a vol selling perspective. So that's why I didn't trade it. But I mean, from here, it's completely different, though. You can trade downside drift in something like Intel. I think that's okay, especially with how bad the miss was. But I also think that it was really broadly supported by a lot of buy volume today, a ton of buy volume, literally 68% buy volume. So I don't necessarily think that the market hates it down here, and it looks like people are kind of scooping it up in droves. So for me, this would be nothing yet. I would want to see at least another day or two to see how it performs. The thing that you'll notice about my approach to trading is very rarely am I trying to top tick or bottom tick things. I don't care to catch things at like the perfect time. I want to put on stuff that generally shows strength so that there's a higher probability of it doing what I want it to do. That's the idea. So in this kind of scenario, like I just had a big down move, I would favor it to the downside. I wouldn't be opposed to trading something like short puts because I know vol is going to be really high if it starts to base and show strength. Like this kind of scenario is great for selling short puts, right? So you can see drop down, drifted south ever so slightly, started to look okay, and then it's just come off a cliff. So it wouldn't surprise me if essentially this next quarter looked a lot like this past quarter. Like that, I don't think is too crazy. But in order for me to do anything in it personally, I would need to see another couple days. I'm not trying to catch it right at the turn. It's just a really tough way to trade. That's generally going to run unsuccessful, in my opinion. Okla says, what platform broker? This is Thinkorswim, which is through Schwab. Ramalama says, Could you elaborate a little more on the wide wings for selling calls, synthetic short strangle by doing an odd core? Yeah, what about it? When you say Mr. Llama, let me know what you want to talk about specifically there, and I'm happy to. But yeah, that's like a really common approach for smaller accounts, is to just add the longer wings. The other thing sometimes is I'll do it literally just for risk control. If I'm trading something that I have some sort of fear that it might run to the upside and not come back, I'll sell calls against, or I'll buy calls against short calls that are further out of the money. No problem. I just keep it to an absolute minimum. It's very seldom that I'll do that because I'm typically going to lean more heavily on just managing the trade. But that's definitely not outside something I would do. It's completely reasonable, actually, in my opinion. And it's a smarter way, I think, to build positions and to trade. But yeah, Ramalama, if you let me know specifically what you want me to elaborate on with respect to that, I'm more than happy to. I see. Rama says, it seems like the golden egg, being able to manage and execute naked call put selling. Yeah, okay, so you're asking more for the trade-off. And the trade-off is very clear. Vertical spreads typically are negatively expectant by their structure. I'll literally grab my calculator and I'll show you. Let's take a look at a vertical spread in here. Let's do like 49 days. Rama, what do we want to do? Do we want to do a short or long vertical spread? And do we want to do a call or put? Dealer's choice. You tell me. I'm here to accommodate you. Whatever makes you happy makes me happy. Also, fun fact, if any of you guys know anything about Alaska, specifically like Anchorage, Seward area, anything like that, I would love to hear about it. I'm trying to turn off this freaking iPad, but Siri keeps listening to me. Sketchy. Siri's a little sketchy. Short call. Got it. So first, let's take a look at a short call spread. So what I need to do is grab, where is my spread? Over here. So what I'm doing is I'm dropping this in a calculator for me. And let's see. So our strike width is going to be $1. The probability of profit from the time of entry, so the probability of this being in the money, is 43%. So we have like a 57% probability of profit, 57. The credit received here is 39 cents, 0.39. We're going to plan on keeping the whole profit. We're not going to have any sort of stop. And we're not going to have a stop. So the neutral credit, in order for this to be like a neutrally expectant strategy, is 43 cents based on these probabilities. So the moment you enter this trade, you're coming in with negative edge. So that's just a $1 wide vertical spread. Now it gets better if it's wider. So let's do a $5 wide. Let's do, oh shit, clicked the wrong thing, my bad. There we go. So now let's look at a $5 wide. And then the probability of making this $1.15 is same there. This is getting $1.15. So this is still woefully underpaid. Very, very underpaid. So that's the main problem when you add verticals, is you're overpaying for the thing that you're selling, or over not getting enough for what you're selling if you're buying. That's kind of the nature of options. So the other problem with it is you give up a lot of your potential profit. Again, there's a positive, right? You're capturing and you're managing your risk, which that's the thing about trading, is that it's a series of trade-offs so that you can structure things exactly how you want it. So in this case, when we have this kind of vertical, you can see these are all messed up. That's weird. Let me just do like plus or minus 1 standard deviation. So you can see this has had like a really high probability of profit. But the problem is you're trying to make 115 while risking 385. So you need to win a lot of these in order to be able to handle a single loss, right? So in this case, you can see the initial problem if you're not correct directionally. Okay, so Oxshot says broken wing butterfly. All right, let's take a look. But let me know if that answers some of your question, Llama, on like why, like the trade-off, because that's all it is. That's not to say that verticals are terrible. I don't like them in general because I just think it's better to move past them as fast as you can. But like they're not going to break anything. That's kind of the cool part about verticals is that they move slow. So you're not necessarily going to break any records to the upside. And it's not going to be terrible to the downside. I just realized really quick, I have like 2 minutes left to double dash. And your boy we need some milk, man. So give me 1 second before this runs out. What kind of milk do you guys like? I am a whole milk kind of guy. I feel like that's less common now, though. I feel like people are like really... Whoa, that's cool. They have like a Strout Family Creamery. Ain't never heard of that. Let's grab that. Whole milk, spicy avocado. I respect your game. Feel like that's the right go. Keto minded. I see. I like it. Oxshot is going for the balance 2%. That's good. I think that's fair to want to balance it out a little bit. I feel like I'm just a little bit more reckless than that. And I don't actually care. All right. So I got what I need. Let me get this milk order off. Yo, the Strauss Family Creamery organic whole milk, it's half a gallon for $7. They are not playing no games. All right. That was a must. Thanks for hanging in there because milk is like my lifeblood. So if I was going to have Mexican food without milk, I don't know what I was going to do. It was going to be a big problem. Big problem. All right. So back up to this butterfly. Let's take a look. You're looking at 5 AUG, which I don't love because it's really short term. And you're looking at grabbing what options do you want to use? You have to tell me if you want to use calls or puts. Because I want to put on like exactly what you're trying to have me put on. So I see, okay, so you're doing call side. Got it. So we're going to buy the 53.80 Aki. All right, I got to stand up. Oh. Woo. I tell you what, the Rama Llama, thank you very much for that $9.99. That will cover my egregiously overpriced milk. So thank you very much. I very much appreciate that. Very kind of you. But let me see. So, oh man, that's sore from sitting too long. So we're going to buy that, sell 2 of these, grab one of these 95s. Key. Okay, so this is an interesting structure, the way you're doing it. So you can see the P&L graph, exactly how it would behave here. So essentially, this will make $90 and it will continue to try to make $90 up until essentially it hits 53.78 and a half. And then peak profit is what, like 543 at 53.85 or 53.84 and a half, but it's essentially going to be right centered on that strike. So it should be 85 would be the best. Yeah. So it's like 588 there. The graph just isn't perfect. So max profit obviously would be at the center strike. And then we have max loss is 410, and you start to fall into a loss at, let me see. Let me zoom this in. It'll be a little easier to pinpoint it. Let's call it 53.90.86. Something like that. 53.90.86. So what's the probability of hitting 53.90.86 by 5 AUG? 53.90.86-ish. So the probability of that being in the money above that 53.90.86 is like 36%. So 36% probability profit of expiring as of now, but let's see what the probability of a touch is. 53.90, 70% probability of a touch. The reason why I think it's so important to always remember, I much prefer using probability of a touch versus probability of things being in the money. Because you have to remember, the probability that you set is at the time of entry, and the probability that's realized is going to change based on how the underlying moves. So it's kind of a really, really important differentiation to make, right? Because if you use probability of being in the money, that will be whatever number it is at the beginning of the trade. But then as the trade starts to move, that's going to change. And the probability of touch, in my opinion, is a much more conservative metric. Roaring Titty says, what's probability of a touch? Great question. That simply means, what is the probability of price getting to that level before expiration? So probability of in the money is the probability of an option expiring in the money at the time of entry, using current vol. Then the probability of touch is, what is the probability that the price of the underlying touches a point, gets to a certain point? That's probability of a touch, which is a really important metric, especially if you're doing anything that includes managing a trade. It's another giant mistake people make. Zach says, so good touch, not a bad touch. It depends on what kind of touch you like, right? Maybe you like a nice consensual light touch, or nice consensual rough touch, or hard or soft touch. It depends on the touch. Who am I to say what kind of touch you as a person like? But it depends on the kind of touch, because this could be a bad touch or it could be a good touch. Good or bad touch is, as they say, in the eye of the beholder. That's what I say. Oxshot says, thanks for answering. Of course. Happy to. Absolutely happy to. Anything else you guys want to hit? I still got like a few more minutes. We can kind of dance around to whatever you'd like. Oakla says, depends on the toucher. I think that's also a fair cop. Zach says Mara. We can take a look at Mara. I don't really have an opinion on this. I mean, it has vol. That's what I see. Like, I would want to trade vol. Right? It still has a lot of vol. It was down 5% today. Earnings, it was estimated at losing 23 cents. It lost 72, so not good. So this would also be a candidate for kind of a downside drift play for me. But I would primarily do it through something like short calls. Trade this bad boy to the downside. And what would that look like? Yeah, I mean, you get paid a ton right now. But this is one that you would either have to manage very closely, or I would spread it off because this thing can grab legs. But it doesn't look like. It looks like it's been struggling. But again, like this is a great example. This ran from 19 to a high of 27. So like you don't want to get ran over, falling asleep, not expecting that to happen. So 19 to 27, let's call it a 10-point move. If we analyze this and we look at a 10-point move, I'm seeing if my dasher is trying to hit me up. Okay, no, we're good. So yeah, back to this probability, or like what would this look at a 10-point move? So that would take us from spot is 17 to 27. So you have to be ready to take this move, I think, to 27. So what's the probability of touching 27 over the next expiration cycle, which is 20 sep? The probability of touching 27 is like 54%. It's a really good probability. And that would be a really, really massive loss on a relative basis. So I actually wouldn't love this trade personally. It's not collecting enough because you're collecting $106 for that probability of getting up to 27, which would lose you 550, right? So you're making one, risking 5.5. Nah, fam, that ain't it. That's not what I would do. So in this kind of case, if I wanted to trade vol, I probably would have to trade it via a strangle and go both sides so that you can get the put skew. Because these are going to be way more, right? Like on a 29 delta, you're getting $1.30 something compared to $1.08 for the same 30 delta on the call side. So that will kind of even it out a little bit. It'll help you, right? So now if you get up to that 27 handle, you're losing $400, but you're collecting 243 if it hangs out here. Now, obviously you added risk to the other side now, but I would be less concerned with the downside risk because it's already only at $17. So even if it goes down to 7, this lose $563, but what's the probability of it touching down to 7 in this time frame, which is 20 sep? Probability of us getting to 7 for a touch is 4.8%. So you see how I kind of think about how I want to build the trade based on probabilities so that I'm not just, now this looks like a good trade. Before it looked like a problem, but by collecting that put skew side of things, again, you do open up downside risk. So if you have a really strong directional disposition, then there's nothing wrong with just trading the short calls and accept the risk. But for me, when I'm trading something like this personally, my mind drifts towards like variance risk premiums. So a slightly different structure. Akshat says, what is your view on TLT? Yeah, TLT's been interesting. I had a position in it for a while, took it down, built another position, took it down. So right now I don't have anything on in here. But I mean, essentially anything I first saw when it was breaking above here is when my first alert went off. And I absolutely think TLT will continue to rally. My guess is that it'll start getting gummed up in like the hundreds. And so it's getting really close. I think the overall profit potential on this will be fairly limited because even if it gets above this 100 handle and it starts rallying into the one, like that's the thing, right? Like we're now talking about 2-point moves. It's just not that exciting for me. So when I first traded TLT, it was really trading like this move from the high 80s into the mid 90s. That's what I cared about. That was a much better move. And now, even though it looks like it's, going off into the moon on a relative basis, it's just not moving a ton. It's moving, to be clear, like this is a 6-point move. So it's absolutely moving. But now you have to kind of think about where's the top line on it. And if I use just longer term references, like I think the time it will take it to get back up towards like the mid ones is going to be a hot minute. And it's got a lot to get through in order to get there. So I think there will be plenty of buy opportunities that will show up in the interim. So like I'll set alerts like this so that I can see them. Don't need this. I don't need that. So what I'll do is I'll set like different thresholds. So as it's breaking above various levels, I'll track it. But it's got a lot it's got to get through before it really can, in my opinion, like open up meaningfully. So that is the thought on TLT. All right, gang, time for me to pack it up. Like I said, I'll be out of touch for about a week. So you guys will be on your own to hold down the fort. If you're in the Discord, make sure you're playing nice in there, doing the good things, paying attention to that risk. I hope you all have a killer weekend. Do not forget to be an outlier. No live streams next week. Back on the week after that. I'll see you guys later.